Hello everyone, welcome to EduTap and welcome to Finance 360-degree session. In today's session, we are going to discuss three very important RBI notifications and three very important finance current affairs. Okay, so these are important because of the yearly data that the press releases have shown. Okay, so these are the RBI press releases. So they have shown the yearly data that is very important from the examination point of view. Okay, and from such kind of news articles, from such kind of RBI press releases, previously also in the previous years we have seen the direct questions, and I will tell you that from where the questions have come. Okay, so this is the three RBI press releases that we are going to discuss, that is giving you the external debt data, the yearly external debt data, the yearly foreign exchange reserves data, as well as they are giving you the yearly balance of payment data. Okay, so these are the three press releases that the RBI has released, and these are the three finance current affairs that we are going to discuss in today's session. So give me a thumbs up if I'm clearly audible and visible and everything is fine. Good morning everyone. So thank you for coming to the session, and let's start with the session. So first of all, India records 13.5 billion current account surplus in Q4, and the yearly data has also been released with the quarterly data. Okay, India's current account deficit falls to $23.3 billion in financial year 2025. So this we are going to discuss, that the current account deficit has fallen, but what is the actual situation of the foreign exchange reserves and the balance of payment. Okay, so foreign debt climbs, foreign debt has increased, and the foreign debt has increased by 10%. So what is the increase that we have seen? What about the short-term debt and the long-term debt? All of this we are going to discuss in today's session. Okay, so let's get started. But before that, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay, so let's start with the first news article, with the first press release, that is India's external debt as at the end of March 2025. Okay, so at the end of March 2025, the India's external debt, so external debt means the external liabilities that India has, the external liabilities that India has, that is the money that we have to return back. Okay, so India's external debt or India's external liabilities was placed at $736.3 billion. So this is the external debt, or this is the external liability of India, that has increased by, or there is an increase of $67.5 billion over its level at end March 2024. So from 2024 to 2025, there is the increase that we have seen in the India's external debt, in the India's external liabilities by $67.5 billion. And now the India's external debt in March 2025 stands at $736.3 billion. It is a huge amount, that is the India's external debt. Now the external debt to GDP ratio, that is the external debt to GDP ratio multiplied by 100, so that is in the percentage form. So the external debt to GDP ratio increased to 19.1% at the end of March 2025 as compared to 18.5% at end March 2024. So you can see that the external debt to GDP ratio has increased slightly from 18.5% to 19.1%. Okay, now this data point is very important. Okay, the next one is regarding the valuation effect. So now see the valuation effect due to appreciation of US dollar. Why the US dollar has appreciated, why the benefit is coming due to the appreciation of US dollar. So let's say that you require 1,000 rupees as debt, and you are taking this debt in the form of dollars. Okay, you are taking this debt in the form of dollars. So if $1 is currently equal to 100 rupees, so how much dollar would you require to get the 1,000 rupees? So you are taking the debt in the dollars form, you are taking the debt in the form of foreign currency, in the form of dollars. So $1 is equal to 100 rupees and you require 1,000 rupees. So how many dollars are you going to borrow, or what is going to be your debt? It is going to be $10, right? Basic maths. So $10. Now let's say that the dollars has appreciated, and now $1 is equal to 200 rupees. So this is the appreciation of dollars, because now you have to give more rupees to get $1. So the dollar has appreciated, the dollar has become stronger. Okay, so now can you tell me that to get 1,000 rupees, how much of dollars you have to pay? Now can you tell me that for 1,000 rupees, how much dollars do you have to give now? $10, $20, $30, how many dollars? would you require for getting 1000 rupees? Before you required $10, but because of the appreciation of dollars, now you require only, how much dollars you require? Now you require only $5. Okay, because the dollar has appreciated and the dollar is like, it is equal to 200 rupees and you have to give more rupees to get $1. So now by getting $5, you will be getting 1000 rupees, right? So that means when the dollar is appreciating, you require lesser of the foreign currency to cover the debt, So valuation effect due to appreciation of US dollar. So because of the appreciation of US dollar, where you require 1000 rupees, to get the 1000 rupees, before you needed to get $10, but now because of the appreciation of US dollars, let's say you only require $5. So that means you require lesser dollars to provide you the money that you want. So because of the appreciation of the US dollars against the Indian currency or Indian rupee and other currencies amounted to US dollar 5.3 billion. So the appreciation that has happened in the US dollar against the Indian currency and against the other currencies, this has amounted to US dollar 5.3 billion. So that means if the US dollar has appreciated by 5.3 billion dollars, that means we required this much less amount we required to cover our borrowing. Okay, so excluding the valuation effect of 5.3 billion dollars, external debt would have increased by US dollar 72.9 billion dollars, but it actually increased by 67.5 billion dollars. So the basic idea is that the external debt from March 2024 to March 2025 increased by 67.5 billion dollars. If the appreciation of dollars would not have happened, our external debt would have increased by US dollar 72.9 billion dollars. Any confusion anyone has? So if the US dollars would not have appreciated, our borrowing would have increased by, the external debt would have increased by 72.9 billion dollars. But because the dollar appreciated, and that's why we required less dollars to provide the borrowing in our country, so we only increased the external debt by 67.5 billion dollars. Okay, got it? Got it? Any confusion? 200. Okay, got it? Okay, so nice. So valuation effect due to the appreciation of dollars. Because of appreciation of dollars, India required to borrow, India required the additional external debt of 67.5 billion dollars against the 72.9 billion dollars. Now at the end of March 2025, the long-term debt with original maturity of above 1 year. So long-term debt is the debt with original maturity of above 1 year. So at the end of March 2025, the long-term debt was placed at US dollar 601.9 billion, recording an increase of US dollar 60.6 billion over its level at March 2024. So basically you can see that out of the total external debt that was till March 2025, the majority of the external debt is in the form of long-term debt. Okay, so at the end of March 2023, the long-term debt, the total long-term debt was placed at US dollar 601.9 billion, recording an increase from the previous year of from the previous year, the long-term debt has increased by US dollar 60.6 billion dollars. Okay, now the share of short-term debt. Coming to the share of short-term debt. So short-term debt are the debt with the original maturity of up to 1 year. So in the total external debt, the majority is the long-term debt. In the total external debt, the 18.3% is the short-term debt. Okay, 18.3% is the short-term debt. So the share of short-term debt in the total external debt declined to 18.3% at the end of March 2025 from 19.1% at the end of March 2024. However, the ratio of short-term debt to the foreign exchange reserves has increased to 20.1% at the end of March 2025. Okay, so the short-term debt in the total external debt has decreased to 18.3% in the March 2025, but the short-term debt to the foreign exchange reserves, this has slightly increased to 20.1%. Now short-term debt on residual maturity. So try to understand that the short-term debt to the original maturity means that these are the debt that have the original maturity of less than 1 year, okay. Now the short-term debt or on the residual maturity basis, the short-term debt on the residual maturity basis means that these are the short-term debt that have the original maturity of less than 1 year, as well as these are the long-term debt that have the residual maturity of less than 1 year. Okay, so short-term debt on the residual, short-term debt on the original maturity means this is the original maturity of less than 1 year. The debt has the original maturity of less than 1 year. But the short-term debt on the residual maturity basis means that this is the short-term debt with original maturity of less than 1 year, or long-term debt that is having the residual maturity or left out maturity of less than 1 year. So this is the idea of the short-term debt on residual maturity basis. So that is the debt obligation that include the long-term debt by original maturity falling due over the next 12 months. So debt obligations that are the long-term debt that have the residual maturity of less than 1 year, or that is going to mature over the next 12 months or less than 1 year, we can say. And the short-term debt by original maturity that is of up to 1 year constituted 41.2%. So you can understand that the short-term debt on the residual maturity basis that have the original maturity of up to 1 year, or the long-term debt having the residual maturity of up to 1 year. So these kind of debt constituted 41.2% of total external debt at the end of March 2025, and the short-term debt on the residual maturity basis to foreign exchange reserves, this stood at 45.4%. Okay. So this is the idea. Any confusion till now, anyone? And the short-term debt that have the original maturity, they have the original maturity of less than 1 year, or we can say up to 1 year. Okay, up to 1 year. Next is US dollar denominated debt remained the largest component. So remember this, that the US dollar denominated debt remained the largest component of India's external debt. So the highest external debt that we have taken it in the form of dollars, with a share of 54.2% at the end of March 2025, followed by debt denominated in the Indian rupee, then in the yen, SDR and euro. Okay, so the highest or the largest component of India's external debt we have taken in the form of US dollars. Now outstanding debt of both government and non-government sectors increased at the end of March 2025 over the level a year ago. So outstanding debt, the debt that we have to return, has increased on the basis of the government as well as non-government sectors. Okay. Next is the share of outstanding debt of non-financial corporations. The share of outstanding debt of non-financial corporation. Financial corporations are your banks, NBFCs, insurance companies, pension funds and such. So non-financial corporations are the infrastructure companies, let's say, or the basic companies, the textile industries that we have, the automobile industry that we have. So those are the non-financial corporations. They are not directly related to the finance sector. Okay. So the share of outstanding debt of non-financial corporation in total external debt was the highest at 35.5%, followed by the deposit taking corporations like the banks, except the central bank, that had 27.5% of the total external debt, general government then, and other financial corporations. Okay, so you always have to remember that which is constituting the largest component. Okay, so in this case also, which is constituting the largest component, after that what comes, and after that what comes. Now next is loans remain the largest component of external debt. Now here also the largest component, then after that the numbering is given. Okay, so the loans remain the largest component of external debt. As I have told you that external debt do not only mean borrowing. External debt means all the external liabilities that we have. All the external liabilities means all the money that we have to return. Okay, so even the non-resident Indians, they are doing the deposits in our country. Okay, they are doing the deposits in, let's say, State Bank of India, the Punjab National Bank, and the different banks in India. Now, do we not have to return this money, or do we have to return this money? Residual maturity means, let's say you have taken a loan for 4 years. So this is the original maturity. Now 3 years of this loan has passed. So only 1 year is left. So what is the residual maturity? Can you tell me? Krish, can you tell me what is the residual maturity here? If the original maturity is 4 years and 3 years of the loan has already passed, the 3 years have already passed. So what is the residual maturity? 1 year. This is the left out maturity for which you have to continue the payments, right? So this is the residual maturity, okay, the left out maturity. So the short term debt with the residual maturity means that short term debt that have the original maturity of up to 1 year, or the long term debt that have the residual maturity of up to 1 year. So they are the short term debt of residual maturity, okay. Got it. Okay, nice. Now coming to this idea, now the NRIs, they are depositing their money in India with the State Bank of India, with the Punjab National Bank. So now these deposits, do we have to return this deposit? Yes, we have to return this deposit to the individuals or to the entities that have deposited the money in our country. So basically the foreigners, the non-resident Indians, the NRIs, they are depositing their money in India, okay, in the banks of India, in the financial institutions of India. Now we have the obligation to return this money whenever the depositors demand, okay. So this money will go back to the other countries. So you can understand that this is also the liability. This is also the liability that we have taken the money, but we have to return the money whenever the depositors demand. So loans remain the largest component of the external debt, the external liability, with a share of 34.0%, followed by the currency and deposits that we have taken from the non-resident Indians, from the NRIs, from the foreigners. We have taken the deposits. So after that, this component comes, and then the trade credit and advances. So pay later, buy now. Can we say that this is also a kind of liability? We are buying now, we are importing now, but we are saying we will pay later. Okay, let's say that a big company, a big corporation has done the imports of 100 crores rupees. Now the big corporation is saying that we have a good connection, we have been doing business for past 10 years, so we are buying now and we will pay in the next month. At least let's say 40 crores we will pay next month. So 60 crores we have paid, we will pay 40 crores in next month. The other institution is saying, okay, we have a connection for a long time, so you can pay 40 crores later on. So this is the pay later. Pay later. So this is also a liability. We have to pay anyway, right? So this is also a liability in the form of external debt. Got it? So this is the trade credit and advances. We have taken the products, but we will pay later. So that is trade credit and advances. Okay, so pay later, buy now. And debt securities, debt documents, these are the financial instruments, okay, through which we are taking the borrowings in a way. Okay, so any confusion anyone has in this? So debt service, now the principal repayments and interest payments. So we are doing the debt servicing, we are paying, like if you have taken the loan, you have to pay the EMI, the equated monthly installments, right? So if you have taken a loan, it is not for free. You have to give the EMIs that constitute a part of the principal and the interest. Okay, so debt service means if the government has taken the loan, if the financial institutions, if the non-financial corporations have taken the loan, they have to service their debt. That means they have to do the repayments, the principal repayment and the interest payments they have to do. So the debt service marginally declined to 6.6% of the current receipts that we are getting at the end of March 2025 from 6.7% at end March 2024. So basically the debt service has marginally declined to 6.6% of the receipts that India is getting. Okay. Any confusion anyone has till now? So this is the first news article where we have discussed the important points of the India's external debt. So we have discussed the important points are that India's external debt has increased to US dollar 736.3 billion. And this is an increase of 67.5 billion from March 2024 to March 2025. The external debt to GDP ratio increased to 19.1%. So there was valuation effect, and that's why the debt has increased by $67.5 billion rather than $72.9 billion. Okay. Next is that long-term debt is the biggest component of external debt. And then there is the share of short-term debt, that is 18.3%. The short-term debt on the residual maturity basis constitute 41.2% of total external debt, and US dollar denominated debt remained the largest component in India's external debt. Okay, the share of outstanding debt of non-financial corporation to external debt, this was the highest. Then loans remained the largest component of external debt, and debt service is 6.6% of the current receipts at the end of March 2025. So do remember that numbering wise, which is the first, which is the second component, which is the third, and which is the fourth, and so in such kind of lines you have to remember first, second, third, and fourth. And a question previously in the last year RBI Grade B examination, a question has come on the share of short-term debt to the total external debt. Okay, so such kind of question has come. Now coming to the sources of variation. Now coming to sources of variation in India's foreign exchange reserves during April to March 2024-2025. So this is the foreign, like how much the foreign exchange reserves have changed. So what is the variation that has come in the foreign exchange reserves of India during the April-March 2024-25? So the yearly data we are going to see. Okay. So the balance of payment. Can you tell me that what are the two important components in the balance of payment? So balance of payment has two important components, has two important accounts. What are these accounts? The capital account and the current account. The current account and the capital account. Now in the current account there are three parts of the current account, that is the trade in goods, the trade in services, and the transfer payment. Okay, in the capital account you have the investments, the borrowings or the external debt we can say, and the external assistance. Okay, so this is the idea. So current account consists of all the like regular payments, the trade in goods that we are doing, the trade in services, the transfer payment, that is the remittances that are coming in from foreign, and the remittances or the gifts that we are giving to other countries. Capital account consists of the asset that we are building, or the asset, the investment, and the external debt and external assistance. So this is the balance of payment. Okay, so balance of payment has two major accounts, that is the current account and the capital account. Now the current account is in deficit. So it was last year also it was in deficit, this year also it is in deficit. So it is in deficit of $23.4 billion. Now you can see that the deficit has slightly reduced as compared to the past financial year. Okay, so current account balance is negative or is in deficit of $23.4 billion, and you can see that the deficit has slightly decreased as compared to the past financial year. Now capital account, the shocking thing is in the capital account. The capital account you can see that it is in surplus. The capital account, the investment, borrowing, and external assistance. So this account consisting of these components, it is in surplus, but you can see that the surplus has decreased from $89.8 billion to only $18.3 billion, and the problem comes from here. Okay, so here you can see the other data point also, that the foreign direct investment has decreased. So the foreign direct investment has decreased from $10.2 billion to $1 billion. The foreign portfolio investment has decreased from $44.1 billion to $3.6 billion. The foreign institutional investment, that is a part of foreign portfolio investment. Okay, so now banking capital, the banking capital has gone into deficit, so means our assets are decreasing, the banking assets are decreasing. So this is the basic idea. The external assistance has also slightly declined. So major problem is coming from foreign direct investment, foreign portfolio investment, and the banking capital has also decreased a lot. So you can see that the current account is in deficit. The current account is in deficit, but the deficit has decreased in the current account, and in the capital account there is surplus, but the surplus has decreased immensely. Okay, now can you tell me that if we have in the balance of payment in the current account, so in the balance of payment in the current account we have the deficit of $23.4 billion, and in the capital account we have the surplus of $18.3 billion. So can you tell me that balance of payment will be in surplus or deficit? If in the current account we have the deficit of $23.4 billion and in the capital account we have the surplus of $18.3 billion, do we have a surplus or deficit? We have a deficit, right? We have a deficit of nearly $5 billion. We have a deficit of $5 billion. Now, who is going to pay for this deficit? Who is going to pay for this deficit? Because the current account, capital account, they are not going to balance themselves out. They are not balancing themselves out. So the current account, majorly we have the deficit. We have the deficit because of the trade in goods. We have the deficit in the trade in goods. The trade in services in the current account. In the current account, the trade in services is in surplus. The transfer payments are in surplus, but the trade in good is in deficit. And for the imports, trade in good means for the imports that we are doing, we have to pay. We have to pay. So how are we going to pay for the imports that we are doing? Through the foreign exchange reserves, because the trade in goods is in deficit. We are importing more than the exports that we are doing. So for this deficit, we have to pay through our foreign exchange reserves. So if the balance of payment is in the deficit of $5 billion, if the balance of payment is in deficit of $5 billion, that means we have to release the $5 billion from the foreign exchange reserves. Got it? Yes, very good. So this is the idea that the total deficit is of $5 billion. Okay, so we have to release $5 billion. So on a balance of payment basis, on the current account and capital account basis, that is excluding the valuation effect. For now, do not consider the valuation effect that we are going to consider in the coming points. Okay, so on the purely on the balance of payment basis, the foreign exchange reserves decreased by $5 billion during the 2024-25 as against an acceleration of US dollar. So in the previous year, if you see, can you tell me that in 2023-24, did we have a surplus or did we have a deficit? In the 2023-24, did we have a surplus or deficit? Anyone? So in the 2023-24, we had a current account deficit of $26.1 billion and we have a capital account surplus of $89.8 billion. So that means we had a surplus of $63.7 billion. And now if you see, we have a deficit of $5 billion. So in the previous year, in the previous financial year, we had a surplus of $63.7 billion. During the 2023-24, that has turned into the deficit of $5 billion. So the foreign exchange reserves decreased by $5 billion to cover the balance of payment deficit that we have faced in 2024-25. Okay, so this is the idea. Now foreign exchange reserves in nominal terms, that is including. Now in the foreign exchange reserves, do you know that what comes in the foreign exchange reserves? The foreign exchange reserves consist of the foreign currency asset, that is the dollars, euro, pound sterling, Chinese yen, Japanese yuan. Japanese yen and Chinese renminbi. So these are the foreign currency asset, okay, in the foreign exchange reserves. Then the foreign exchange reserves also consist of the gold. Okay, now from the foreign currency asset, a part of the currency is invested in the securities also, the debt securities and other kind of securities. Okay, so foreign exchange reserves in nominal terms, if we discuss about the foreign exchange reserves only, so balance of payment, we have seen that the balance of payment is in deficit, and due to that the foreign exchange reserves of $5 billion have to be released to cover the deficit of balance of payment. Now the foreign exchange reserves, when we consider them, including the valuation effect, you know that the gold prices have increased immensely. The gold prices have increased immensely. There is immense increase in gold prices that is coming recently. So in this consideration, if we see that the foreign exchange reserves have decreased by $5 billion, but that should be covered up through the increase in the value of gold. If RBI is keeping 100 metric tons of gold, let's say, so gold value is increasing very rapidly, so foreign exchange reserves value should be increasing, right? So this is the idea that the foreign exchange reserves in nominal terms have actually increased by $21.9 billion during the 2024-25 as compared with an increase of $68 billion in 2023-24. So here you can see that change in foreign exchange reserves, including the valuation effect, the effect of increase in gold prices. So just a second. Okay, so change in foreign exchange reserves including the valuation effect. So in 2023-24, actually on the balance of payment basis, in 2023-24 there was a surplus of $63.7 billion. Okay, and in 2024-25 there is a deficit of $5 billion on the balance of payment basis. Now the valuation effect, that is gain or loss. So actually in 2023-24 and 2024-25 there is gain that has happened in the valuation area because the foreign exchange reserves value has increased because the increase in gold prices. So in the 2023-24, the valuation effect was $4.3 billion because gold prices were increasing. Okay, but in 2024-25, the gold prices increased rapidly. Not only the gold prices, the value of certain securities also increased. Okay, so here the valuation effect is $26.9 billion. Okay, so this $26.9 billion increase in the value of foreign exchange reserves because of the increase in gold prices covered a part of the covered the balance of payment deficit. So here you can see that the valuation gain primarily reflecting the higher prices of gold and lower bond yields. Lower bond yield means higher bond prices, right? So if we are holding the bonds, that means we are holding the bonds, the bond yields have decreased in the market, but our bond prices are increasing. I hope you know this is basic finance terminology, that if bond yield is decreasing, if the bond returns are decreasing, the bond prices are increasing. That means RBI is holding various debt securities, various bonds RBI is holding, so the bond prices are increasing. The value of gold is increasing as well as the bond prices are increasing. This has led to increase in valuation of the foreign exchange reserves that the RBI is holding. So the valuation gain is primarily because of the higher prices of gold and lower bond yields leading to higher bond prices, amounted to US $26.9 billion. So the valuation of foreign exchange reserves has increased by $26.9 billion, out of which the RBI had to release the foreign exchange reserves of $5 billion to cover the deficit in balance of payment. So the change in foreign exchange reserves, including the valuation effect, is $21.9 billion. Any confusion here? Clear? So let me summarize this point also. So basically the balance of payment in 2024-25 is in deficit of $5 billion. That means foreign exchange reserves have to be released to cover this deficit of $5 billion. Now the foreign exchange reserves in terms of valuation, the foreign exchange reserves have increased by $26.9 billion because of the gold increase in gold prices and increase in bond prices. Okay, so if the foreign exchange reserves, the $5 billion of foreign exchange reserves are released to cover the deficit in balance of payment, so out of the valuation, out of the increase in valuation, the foreign exchange reserves have actually increased by $21.9 billion. Okay. So this is the idea, that the foreign exchange reserves have actually increased by $21.9 billion after paying for the deficit in balance of payment. Got it? Now coming to development in India's balance of payment. So till now we have discussed it from the foreign exchange reserves perspective. Now let's discuss some important points in the India's balance of payment. So India's current account deficit. So I have told you that balance of payment has current account and capital account. So in the current account there is trade in services, trade in goods and transfer payment. Okay. So India's current account deficit at US $23.3 billion, that is 0.6% of the GDP. During 2024-25, this was lower than US $26 billion, that was 0.7% of GDP. So basically, the current account deficit has decreased from 0.7% of the GDP to 0.6% of GDP. This is the important data point that you have to remember from the exam point of view. So India's current account deficit has decreased to 0.6% of the GDP. Okay. Net invisible receipts. Now the current account consists of the trade in goods, that is called the visible trade, Now the trade in services and the transfer payments, they are known as invisible receipts. So the net invisible receipts, that means how much we have actually received after paying for the services, after paying for the transfer payments, how much we have received by providing our services, by getting the transfer payment. So how much we have actually received. Net invisible receipts were higher during the 2024-25 than a year ago on account of services and personal transfers. Okay, so basically the services that we are exporting has increased, so we received more for the services that we are providing, and we have received more in the personal transfers, in the remittances also. Okay, so the remittances increased and the export of services increased, due to which we were able to get more in the net invisible receipt. Net inflow under FDI. So net inflow, see, net always means that how much we are getting minus how much we are providing. So we are getting the FDI foreign direct investment, we are doing the FDI in other countries also. So net FDI is means that how much actually we are getting. Okay, so let's say we are getting the FDI of $100 billion and we are doing the FDI of $40 billion. So the net FDI will be $60 billion. Okay, so how much we are getting minus how much we are giving, so that is net amount. So net FDI inflow was at $1 billion during 2024-25, was lower than the $10.2 billion that we have received previous to that financial year. Okay, during 2024-25, the FPI recorded a net inflow of $3.6 billion, lower than the $44 billion that was received in 2023-24. Okay, there was a depletion of $5 billion in the foreign exchange reserves on the balance of payment basis during the 2024-25. So this is the overall idea from the balance of payment perspective that we have already discussed in the sources of variation also. Now coming to the quarterly data. So the news articles were discussing the quarterly data also. So let me show you a few important points that you have to keep in mind. So basically India's current account balance recorded a surplus of $13.5 billion in the last quarter of financial year 2024-25. So in the quarter 4 of financial year 2024-25, there was the current account surplus that was recorded. It was 1.3% of the GDP. Okay, so India's current account balance recorded a surplus of $13.5 billion. That was 1.3% of the GDP was the surplus in the quarter 4 of financial year 2024-25. Okay, now the net service receipts. So service receipts, net means how much we are getting as compared to how much we are providing. So whatever is the net amount, this increased to $53.3 billion in the quarter 4. And this was the net service receipts have increased because of the business services that we are providing and the computer services that we are providing to the other countries. Got it? Any confusion, anyone? So this is it for today. If there is any confusion, you can ask me. So we have discussed the balance of payment data, we have discussed the quarterly data. You can read it out, but those are the most important points that you have to keep in mind. Okay. So this is the first question. I hope you will be easily able to answer this question. And let me tell you that the Perspective 360-degree series, this is for your answer writing practice. Okay, so if you are afraid that how to write the answers and what are the current topics that you have to focus on from the answer writing practice point of view, so the Perspective 360-degree series is launched for you in YouTube on Monday, Wednesday, Friday at 5 p.m. You can see the Perspective 360-degree series where Jaskaran sir discusses a topic with you from the descriptive point of view, and these topics are relevant from the current affairs point of view. Okay, as well as these questions have direct chances coming in the examination in the descriptive part of the examination. Okay, so here in the Perspective 360, a homework question is also given to you. If you write the answer within 24 hours, within 48 hours in the comment section, so the answer also gets evaluated. Okay, so this is the idea. Now this is the first question. I hope you will be easily able to answer this question. Now this is the second question. Read the question very carefully and then try to answer this question. So this is the second question. Now coming to the last one, that is the third question. So this is the third question. Again, read the question carefully and try to answer this question. This is in regards to the yearly data for the for your current account deficit and for your balance of payment. Okay, so try to answer this question. So these are the three questions. I hope today's session is clear to you. If there is any confusion anyone has, do ask me right now. Otherwise, I will be ending the session. So thank you everyone. Do give the right answer of the three questions. And if you have any confusion, you can ask in the comment section below. Okay, so do ask your queries in the comment section below and do give the right answer of the homework question. Okay.